Dear students, I have seen several students find difficult to solve the practical question on the financial management in business study class 12. I am going to share certain number of questions with complete solution and understanding. As the topic is quite challenging, I am going to explain the solution in detail. So the video is going to be a bit lengthy. You need to maintain patience and watch the entire video in order to understand the concept. We are going to start with part 1. Here you can see the case study followed by two different questions. This question has appeared in the CBSE Delhi outside Delhi examination 2020-2016. First, we need to read the question. First question is state whether the shareholders gained or lost in respect of earning per share on the diversification. Show your calculations clearly. Second, also state any three factors that favor the issue of debentures by the company as a part of capital structure. Before we read the case study, we need to understand certain different concepts. That is meaning of diversification. When a company expands the business by adding more products, it is known as diversification. Capital structure means deciding the ratio between debt and equity. It is known as capital structure. So under which situation the fund should be raised through debt component, and under what situation the company should raise the fund through equity component. Equity component carries equity share capital, preference share capital and the retained earnings, and the debt component include debentures and the long-term borrowings. For the purpose of simple calculation and understanding, under equity we are going to consider only equity share capital, and under debt component we are going to consider only the debt component. So now we have to see whether the company should raise the fund through equity share capital or the debt component. We need to understand the merits and the limitation of both the components. So when a company's financial position is weak, in that case the company should rely only on the equity share capital. Because in case of equity share capital, company is under no obligation to pay any kind of dividend if the company does not earn profit or has no or bears the losses. It means in case of equity share capital, company can enjoy complete freedom in running the business. But in case of debt component, if the company is not enjoying good financial position, in that case we it has to pay fixed amount of interest whether the company has sufficient profit or not. It means in case of weak profits, the company should rely on the equity share capital but not on the debt component. But as the company's financial position improves or it becomes strong, in that situation, the company should not rely on the equity share capital, because if more and more equity shares are issued, in that case, new equity shareholders will also enjoy the higher amount of profit for which they don't deserve it, because on the higher profit side existing shareholders do have the right and they deserve to gain from the higher amount of profits. So when the financial position becomes strong, in that situation the company should rely on the debt component instead of raising the fund from the equity component. So after raising the funds from the debt component, company will have to pay a very fixed or nominal rate of interest, and after paying the fixed interest the rest of the profit will be available to the existing equity shareholders only. So as the profit rises, then the definitely earning per share will also rise. But in this situation we have to ensure, we have to see whether the earning per share of the existing shareholder have risen or not after raising the fund from the by raising the fund from the debentures. Now let's read the question. The VO Limited is a company which manufactures textiles. It has a share capital of 60 lakh. Earning per share in the previous year was rupees 50 paisa, and for the diversification purpose, the company is requiring funds of rupees 40 lakh, and for this purpose, company has issued 10% debentures. And after issuing the debentures, company has earned rupees 8 lakh on the capital employed, and it pays income tax at the rate of 40%. So profit rupees 8 lakh on the capital employed, that is net profit before interest and tax. So return, what is the formula for return on capital employed? net profit before interest and tax upon capital employed. It means from this profit we need to deduct interest on the debentures, and then we have to deduct the income tax. The remaining profit would be available to the existing equity shareholders, and that profit has to be divided by number of equity shares, and then we will compare earning per share with the existing earning per share. So here the face value has been assumed to be 10, as this was not mentioned in the case study. So 60 lakh is the total share capital, and face value rupees 10, it means 6 lakh would be the equity shareholders, equity share, number of equity shares. Let's understand. So we have to see earning per share. Formula for earning per share is net profit after the payment of interest and tax from the profit upon number of equity shares. Net profit after interest and tax has been determined rupees 40 lakh, and number of equity shares are rupees 6 lakh. Net profit after interest and tax has been calculated on the next page. Here you can see how this has been calculated. So we have been given profit before interest, tax and dividend, that rupees 8 lakh. And from this profit, first we have to deduct interest on the debentures are rupees 40 lakh, and rate of interest is 10%. So we will deduct 4 lakh rupees from 8 lakh, and the profit available will be after interest but before tax rupees 4 lakh. On this 4 lakh we have to pay 40% tax, that is 1 lakh 60,000. So after paying interest of rupees 4 lakh and tax of 1 lakh 60,000, the remaining profit available is 2 lakh 40,000, and this is the profit which is available for the shareholders. So here only there is one shareholder, equity shareholders. So earning per share is rupees 2 lakh 40,000 upon number of equity share, that rupees 40. Now what we can conclude? Before raising the fund through debt component, earning per share was rupees 50 paisa, and now it is rupees 40 paisa. It means the earning per share has declined. It means after raising the fund from debt component, instead of increase in the earning per share, it has decreased. Now we have to understand why it happened so. It happens when the rate of interest on the capital employed or rate of investment, return on investment, is less than the rate of interest. So we can understand this point. Yes, what's the takeaway? Why earning per share has decreased? To take the benefit of raising funds through debt component, it is necessary that return on investment must be more than the rate of debt. And capital employed was rupees here 1 lakh, 1 crore rupees, 60 lakh plus 40 lakh, and return on investment is rupees 8 lakh, that net profit before interest and tax upon capital employed into 108%, whereas the rate of interest on the debt is 10%. So it means where the company's rate of return on capital employed is 8% and the rate of tax is 10%, it means the company has borne a loss of 2%. So in order to increase the earning per share, it should be otherwise, that return on capital employed or return on investment must be more than the rate of interest on the debt. In that case, earning per share will increase, otherwise it will not increase. So as the earning per share increases, then it is known as trading equity, but here there is no trading on equity. So this is the basically understanding of first part. I hope you must have understood. Now let's understand second part. So second part was basically we had to see three factors. We had to state and three factors which basically favor the issue of debentures, that under what situation the debenture should be issued. So these are the factors of determining capital structure. All the factors are not favorable. Out of all these factors, certain factors are favored, like cash flow position. If the cash flow position of a company is strong, in that case, the company should take a risk of issuing debentures, because in that case, company can pay the amount of interest in cash easily. If the profits are available but the cash is not available, if the cash crunches are there, definitely in that case the company will not be able to pay interest. So in that case, the company should avoid debentures. Interest cover ratio should be higher than the rate of interest on the debt component. If it is so, then the company should remain dependent on the debt component. Return investment, as I have already explained, the return on investment or return on capital employed should be more than the rate of interest on the debt. In that case, the fund should be raised through debt component. Tax rate, if tax rate increases, then the cost of debt decreases. This has been explained in NCRT, and I will also have a separate video on it. So if tax rate increases, in that case debt become cheaper. So in such a case, debentures can also be preferred. Control, if the control consideration has to be kept with only the existing shareholders only, then the new debenture should be issued. If the control consideration doesn't matter, then the further funds can be raised by issuing the fresh equity shares. Flexibility, if there is flexibility in the repayment options, like a company can repay at its own convenience at any point of time, then raising the fund through debt component should be preferred. Stock market condition, if the company stock market condition is bearish, that companies that the investors are not in a mood to invest in the equity share, like in the case of just like a war is going on between Russia and Iran. So stock market condition has gone down. In such a situation, new investor will not like to invest in the equity shares. So if the stock market conditions are not favorable, in that case, the investor would like to invest in the debentures part only. So these tick parts or tick factors are basically favorable for the issuing debentures.